webinar of Understanding Financial Analysis hosted by Motilal Oswal. So today we'll try to understand what exactly is financial analysis and why it's important and what role does it play in selecting a stock from a long-term perspective. So if you're a long-term investor, then it's really important to understand the basics of financial analysis and what does it what does it exactly mean and how should one interpret it in order to make the right decision to invest into the markets. So even if you say get the financial ratios of financial analysis from your broker or say from a financial site, still it becomes important for you to at least understand the basics of exactly what do they mean and what one can interpret from it. So then you would be able to make the right decision. Otherwise, many times it happens that you end up buying into a company with say too much debt, or one which is like too expensive, or one which is suffering from say low profitability or some other issues of corporate governance or whatever be the case. So financial analysis will actually help you in understanding at least the basics of the financials and how one should exactly look into it. Now, so what is financial analysis? Now, financial analysis is nothing but it's a window into the financial health of a company. It involves a careful analysis of the entire financial data to find out the company's true worth. So now how can one do it? One has to study the financial statements, that is a profit and loss account, balance sheet, and the cash flow statement. Now, this is very time consuming and cumbersome. So financial analysts like us are there who do this entire rigorous exercise and then come out with a conclusion. But for a retail investor, it makes sense to just look at the broad financial ratios to make a quick analysis. And so basically, what you can do is just understand the key important financial ratios, which should be taken into perspective while analyzing a company, and then take a call on it. While the financial analyst would be guiding you with regards to the entire detailed financials and what do they exactly mean. So now the financial ratios are a key important factor which one looks at while doing the financial analysis. So ratio analysis is basically nothing, but then it's the use of the relationship among the financial statements to understand the financial condition and the performance of a company. And it's really important while taking a decision because it helps you interpret the result, because result on a standalone basis doesn't mean anything. So you'll have to form a relationship between these statements and try to analyze as to the what is the health of the company. Now, the ratios on a standalone basis also doesn't make any sense. So in order to actually interpret and see whether the company is doing well or not, you'll have to make a comparison within the industry as to what is the industry standards, because every industry has different different financial health. I mean, some would be cash rich industry, some would be really capex driven industry. So different industries have different financial parameters. First, you'll have to understand the industry into which it falls, and then you'll have to compare it with its peers or the same to the companies which are present into the similar business. And you can and it's also important to compare the ratios with the history of the company. So you should do the analysis for at least like minimum 5 years, if not 10 years. 10 years gives you a very good picture, but at least 5 years one should do the comparison and see whether the ratios have improved or deteriorated or they are maintained. So it's so there are two kind of comparison one has to do. One has to compare within the company, compare to its history, and you'll have to compare it with the peers who are present in the industry. Now, before going into depth, let's first understand what the financial statements exactly mean. So there is income statement, balance sheet, cash flow statement. Now, when we look at the profit and loss, so profit and loss is nothing but it tells you about the profitability of the company. So it is designed in such a manner that it will show you what are the sources of company's revenue, what are the expenses that the company is incurring, and what is the profit that it has been able to generate over a period of time. And this profit and loss is shared by the company on a quarterly, half-yearly, and annual basis. So Apart from this, then we have balance sheet. Now balance sheet gives you the financial position of a company, and it is at the it gives you the financial position at a certain date, and it is normally at the end of the financial year. Nowadays the companies have started giving the balance sheet at the end of the half year as well. But normally we look at balance sheet which is given at the end of the financial year, and it tells you about the assets and the liabilities that the company has. So basically you will get to know the investing and the financing strategies of the company, the overall debt position and the cash position in the company. Then we have a cash flow statement. So a cash flow statement is about the flow of the cash in and out of the company. And as we all know, cash is a king. So while a business can the misstate their profits, they can do a lot of accounting jugglery, but they can't fudge the movement of the hard cash. So cash flow statement, it provides a true picture of the company's financial health. So it's really, really important to have a look at the cash flow statement. However, in case of the banks and the NBFCs, the cash flow statement is a very limited use actually, because they have a different business model altogether. So, so as I said, it would explain you the change in cash between the periods, and it would give you under the cash flow activities under the three categories, that would be operating, investing, and financing. So now, okay, so I'll come later into in depth into each of the three statements. But first, let's understand why financial analysis is really important, because it helps you in assessing the earning capability and the profitability of the firm. It helps you in understand what is the operating efficiency and the managerial effectiveness, because the kind of strategies that the management would take, so that would actually get reflected into your financial numbers and into the operational efficiency. Then you can make the interfirm comparison, because as I mentioned earlier, on a standalone basis the numbers wouldn't mean anything, so you'll have to do a comparison with the peers. And then you'll have to make this financial analysis would help you actually in projecting the numbers. So while you may not exactly use it for the detailed projections, but on a very broad basis, looking at the historical numbers and looking at the peers, you can do a very rough cut projection as to how the company would perform for the next 2 years, 3 years, what is the kind of outlook that the company is sharing, and on that basis, very broadly, what kind of numbers you can look at. So overall, it helps in decision making into deciding whether the company is expensive, whether it's a good investment or not, and then on that basis, you can take a call and invest into the company. Now let me just spend some time more into exactly what is profit and loss. So in profit and loss, basically, so first you'll see what is the sources of revenue, and there are two forms of revenue. One is the operating revenue, which comes from your core operations. Secondly, it's the other income, which comes from the non-core activities. So now we'll consider at the top the operating revenue, and then we consider the operating expenses. So once we deduct the operating expenses from the operating revenue, what we get is the operating profit or loss, which helps us in calculating the operating efficiency. Then we'll add the other income, we'll deduct the depreciation and the interest expense, and we'll arrive at the profit before tax. And then once we deduct the total taxes, we arrive at the net profit. Now, in case of balance sheet, balance sheet basically helps you in balancing the two sides. So the total assets would be equal to the liabilities plus the owner's equity, and it actually shows what are the assets that the business owns and the liabilities that it owns, and how much is it being funded by the shareholder capital, and how much is being funded by the debt. So now the assets can include the land, equipment, inventory, debtors, goodwill, etc. Liabilities would include your debt, the other payables that a business has. So weak balance sheet, how would you understand whether the balance sheet is healthy or not? So if a balance sheet is is saddled with a lot of debt, then it's a weak balance sheet. If it's a very little debt is there compared to the equity, So then it's a strong balance sheet. So it really depends, and you'll have to look at the current assets and the liabilities and see what is the working capital position. So what is whether it's a net cash balance sheet or it's a net debt balance sheet. So these are certain terms which we'll use later on, which will help us understand whether the balance sheet is healthy or not. Then we come to the cash flow statement. So as I mentioned earlier, cash flow statement has three segments. One is cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. Now, cash flow from operating activities is nothing but it means that the company is able to how much cash the company is able to generate from its operating activities or from its operations. Now, if it's negative, it means that the company is losing money. While your P&L might show profit, the negative cash flow from operations will actually help you understand that the company is actually losing out cash and it's not making money. So then it will ring you alarm in your head that you should actually not look at this company, or you should at least try and understand why this is the case. Secondly, we have cash flow from financing activities. So that will help you understand how is the funding has been done for the assets, investment into assets and all. So whether the company has raised funds in the form of capital from the market, or they have raised funds in the form of debt. So in and out of the financing activities gets reflected in the cash flow from financing. Then we have cash flow from investing activities. So that basically captures whether the profit that has been generated, or the whatever the cash the company has, so whether it's investing into the assets of the company, or whether it's investing into the for say pure investment purpose. So whatever capex that the company incurs, that gets reflected over here, and how it gets funded, that gets reflected into the financing activity. Now, once we look at these three categories, the key thing next would be to look at the free cash flow. Now, what is free cash flow? Now, free cash flow is nothing but whatever the cash that the company generates from the operating activities. From that, we deduct the investment that has been made into the core assets of the companies. That is the fixed assets, whatever investment has been done into the fixed assets. So that's get deducted from the cash flow from operations, and then we get what we get is a free cash flow. Now, free cash flow is the most important thing one should actually look at, because that will actually tell you how much cash the company has got left over with, which can be used to pay the dividends and all. So, and it actually tells you about the health of the company. So whether uh, first first and foremost, if it's free cash, first and foremost, if it's a positive cash flow from operations, so at least the company is able to generate good profit from its operations. Secondly, if it actually able to meet all its capex from the cash that it generates from the operations, and even after that, if it's able to if it's still left over with some cash, then it's a very good sign of a business activity. It's a very healthy sign that the company generates very good cash from its business, and it can retain cash for the future investments. And plus, it also shows that it can finance all its capex plans from the cash that it generates from the business, and it need not rely on the capital markets or the debt market. So the more the cash flow that the company is able to generate on a on a year after year basis, so on a sustainable basis, so that will actually reflect about how healthy a business is. So now, now that since you have understood what the three statements exactly mean and how should one broadly should look at these statements. Now let me come to the most important part for the retail investors. What is really important is the financial ratio. There are certain key ratios which I'll talk about very broadly, 10, 11 ratios, which you should look at. Other detailed ratios, the analysts are there to actually help you with. You can go through their research reports, and if you want to dig deeper. But if you want to quickly glance through on your own, and if you want to interpret on your own, then there would be certain key ratios that I'll talk about. So the ratios are categorized into certain categories, that is the profitability ratios, return ratios, leverage, coverage, operating, and the valuation ratios. Now let me come to each one of them. Now, profitability ratios is nothing but it measures the profitability of the company. It will show you how much profit that the company is able to generate for each rupee of sales that it generates. So there are three key, the ratios one should look at. One is the obviously the growth number you should look at. So how the growth has been at the revenue level, at the operating level, and at the PAT level. And you should compare it with the last 5 years or 10 years performance, whether the growth has been consistent, improving, or it has deteriorated. So if it's in a deteriorating trend, then obviously it's a red flag for you. And if it's improving, then you should understand what are the strategies the company has implemented and why it's improving. So that will help you understand that for next 2 years, 3 years, can you expect this growth momentum to actually sustain, or whether it would be much faster than what has actually happened in the in the past few years. So obviously growth numbers holds a very important key. Then secondly, you will have to look at the EBITDA margin and the net profit margin. Now, what is EBITDA margin? EBITDA margin is nothing but the earnings before interest, tax, depreciation. So this is nothing but the core operating profit, which I talked about earlier. So that this is a core operating profit that you'll have to consider. The operating profit upon operating revenue will give you the EBITDA margin. Now, this is nothing but, say if the company is generating 100 rupees of revenue, and if the EBITDA margin is 20%, then that it means that the 20 rupees is being generated as the operating profit. Now, it varies from industry to industry, and it varies upon the first let me tell you about the industry. So for example, the consumer companies, the IT companies, the auto companies, they enjoy very good EBITDA margins compared to the compared to your other industries, like say metals, infra and all, where the margins are comparatively lower. So it depends upon various things. I mean, what sort of industry they depend upon, what kind of fixed expenditure they have, so and what kind of variable expenditures they have. So these factors determine the operating profitability. And secondly, then within the industry also, you would see a lot of variation. This is because the leaders probably would enjoy much higher margin because they enjoy certain kind of motor. For example, if I talk about the auto industry, now if you look at Aisha sells the ultra premium bikes. So obviously that is the mode that the company enjoys, and it doesn't have. I mean, it hardly has any competitor in India. There are few foreign players which are there, but then there's like hardly any competition. So that helps the company in pricing its product at a very it commands good pricing, and that helps in getting good operating leverage. So that's why its operating margins are as high as 30%. Now let's talk about Maruti. Maruti sells more of, though it has few premium cars, but then it sells more of a mass car. So for them, obviously they cannot price it very high. So their margins are like about 13%. So you can see there's a huge difference. Similarly, in case of HUL, ITC, ITC sells cigarettes. Cigarette is something which it's a more of a you can say a semi-luxury kind of product. So and plus ITC has got huge variety of cigarettes. So it has got ultra premium cigarettes as well. So that helps ITC in enjoying the moat and such high margins compared to HUL, which sells more of staples. Though HUL margins are very healthy, but then still compared to ITC, obviously since it sells more of staples, so margins are comparatively lesser. So similarly, it varies across industries, within industry and as well as across the industries. And similarly, the net profit margin is nothing but net profit over the operating revenue. So at the net level, what is the margins that the company is able to generate? Anything 7-8% plus is a very healthy margin. But there are many industries the capital goods, infra and all, where the margins are a little lower. So it really because those are the debt heavy companies, and they are more of capex driven. So for them, the net profit is not as high as compared to these companies, which are these industries FMCG, IT and all, which are more of debt-free industry. And for them, the it's not very asset heavy companies. Now let me come to the return ratios. So return ratios is nothing but it compares the profit with your with the the capital that the company has. So whatever investment that the company makes into the business, so what is the kind of profit that investment is able to generate? So this is calculated by the return ratios, and the two most important return ratios would be to look at return on equity and return on capital employed. Now, one key thing we should really understand in this is the return ratios. Should be in excess of the cost of capital, and roughly your cost of capital is roughly about 14 to 15%. So, it's if your return ratios are more than 15% on a consistent basis, then it shows that your business is healthy. Otherwise, it's a red flag for the company. So now what is return on equity? Return on equity is nothing but net profit on the shareholders' equity, which is nothing but the net worth, that is the equity capital plus your reserves and surplus. And what is your return on capital employed? Return on capital employed is the earnings before interest and tax upon capital employed. And this is a much better ratio compared to return on equity because it captures the debt as well. Because many companies have to raise debt in order to fund their capex activities. So debt plus equity will give you the total capital which gets invested into the business. And then we look at earnings before interest and tax, because that is a profit that the company is generating before repaying the interest on the debt portion. So what is the profit that the company is able to generate on the total capital that it has deployed into the business? So that is the the return on capital employed. But in both the cases, the return ratios should be more than 15% to tell you about the health of the business. Now, if you look at the automobile industries, FMCG companies, IT companies, they enjoy very healthy return ratios. And so, for example, see Eicher Motors. Now, Eicher Motors return ratios is 28%, which is like really healthy. Now, why is it so? There are multiple factors which come into play. One is the operating efficiency that you enjoy. So, since it enjoys the operating leverage because its EBITDA margins are very high, because it enjoys certain kind of moat. So that actually, uh, the moat that it enjoys helps Eicher Motor garner better profitability. And with good profitability, it has been able to generate better returns on the capital that has been deployed. Whereas in compared to HUL, ITC, if you look, their return ratios are far superior. Now, why HUL return ratios are so healthy? That is because one, obviously they enjoy good operating margins. Secondly, their asset turnover is very high. So the quicker you're able to churn your assets, the faster, the better returns you'll be able to generate. So that's why HUL return ratios are so superior. In fact, ITC, which you saw, enjoys much better margins compared to HUL, but then its return ratios are a little depressed because it has to do a lot of investment into its other non-core business, it has FMCG segment, it has a hotel segment, and these are non-core segments which are there. So those segments require investment because those are into initial stages and all. So that is actually affecting their affecting the return ratios, because a lot of investment is going into the business, into these non-core assets. So within the industry also, you saw how there's a sharp difference between HUL and ITC return ratios. Though ITC return ratios is very healthy, but then HUL enjoys much sharper return ratios. And then return ratios in case of say infra, metals and all, they are much depressed. They just manage to somehow reach 15%, and in many years sometimes they don't even manage to reach 15%. So these metal infra companies, it shows that they are not meant for very long investment cycle. They are more of a cyclical play, and one should look at these companies from a medium term perspective and not from a very long term perspective. Uh, then we have leverage and coverage ratios. So here the two most important ratios are debt equity and the interest coverage ratio. Now debt equity is nothing but debt by the net worth of the company. So basically, see, every company does require a certain debt, and even if they don't require debt, many times it happens like there are like if you're a very cash rich company, if you're generating really strong free cash flows from your business, then you really don't require debt. But still there are certain companies which would be there who would resort to certain amount of debt because uh, a little debt, the cost of debt is actually lower to cost of equity. So the cheaper debt helps you in improving your return ratios further. So there would be some companies who would resort to a certain amount of debt despite having cash in their books. So what one should really look at is, if I mean in any scenario, the debt-free companies are like really it's a very healthy sign of the balance sheet. But even if the company has certain amount of debt, and if that debt equity, if that debt equity ratio, that is debt in proportion to equity, is less than 1x, so then in that case, even that is a pretty healthy sign that the balance sheet is healthy. But if the company has to fund its capex, or it has to run its the day-to-day operations by taking more debt into the business, and debt proportion gets higher than the equity proportion, then it means that the company is not being able to mm, uh, generate enough cash, and it has to again and again borrow money from the market. So then in that case, it's a kind of red flag for the investors, and one should really look at it, dig deeper and understand why the company requires so much debt. Not so as I said, debt equity less than one is a good healthy sign, and if it's a debt-free company, nothing like it. Another ratio which is very important is, if the company has debt in the books, then you should definitely look at interest coverage ratio, which is nothing but EBIT by interest payment. EBIT is your your profit before paying out the interest and tax. So this ratio will tell you how much profit the company generates, and um, uh, so how much profit the companies generate, and what is the capability of the company in terms of interest payment. If your ratio is say less than one, then your company is in a very bad shape because it doesn't generate that much profit so that it can pay its entire interest. If this ratio is say anything between 1 to 2, then it's a alarming situation, because in a bad time, say in the current scenario, when there's the revenue has literally halted for many companies, and your expenses are still running high, so then you're not generating profit. And in such a scenario, how will you service your interest? So, one to the ratio between 1 to 2 is a little alarming situation. But if it's two and beyond two, if it's like say around three or plus, then it's a very healthy sign, because it tells us that even if the revenue gets affected to a certain extent, and thus affecting your profit, but still you would be in a comfortable position to at least service your interest. So, in case of debt heavy companies, the interest coverage ratio becomes really important to look at. But then if your debt equity is less than one, or if it's a debt free companies, then it's a very good sign for the investors, and one can actually then consider looking into the. But then all these ratios have to be studied in tandem. Just don't look at one ratio on a standalone basis. Look at the multiple ratios, and then try to understand the overall health of the company's financials. Next is the operating ratio or the efficiency ratio. Now here, on a day-to-day basis, to run the run the operation on a day-to-day basis, so how efficiently the company is able to run. So there are certain ratios that will help you in understand the day-to-day operations of the business and its efficiency, and these are called the turnover ratios. So the most important turnover ratio would be the fixed asset turnover. Now the fixed asset turnover is nothing but total revenue by the average fixed assets. So it tells you how quickly the company is able to generate revenue from the fixed assets that the company owns. So the healthy, if it's like around 3 to 4 times, then it's a very healthy sign. 1 to 2 times means that the company is not able to churn as fast as it's not being able to generate revenue very quickly, and thus it would always require a lot of investment into fixed assets to keep on like generating higher revenue. Whereas if it's a healthy ratio, that is 3 to 4x, so from the same fixed asset, the company can generate higher revenue. And similarly, we have like the inventory, receivable, payable turnovers, which will tell you how quickly like for example, the inventory turnover, so how quickly the company is able to generate revenue from the inventory that it holds. But the retail investor can avoid looking at the inventory, receivable, payable turnover. It can directly look at the overall working capital turnover, which would be total revenue by overall working capital. Now, what is working capital? Working capital is inventories plus debtors minus creditors. So nothing but current assets minus current liabilities in a very layman language. So this will so total revenue by the current assets minus current liabilities will actually tell us how quickly the revenue gets generated from your working capital. And so the higher the ratio, it means that the less money is blocked into my working capital, and I'm able to churn it very quickly. Another way of looking at it is working capital days. So working capital days is nothing but average working capital by total revenue into 365 days. So this is nothing but it will tell you number of days. So whether the company is able to the money that gets blocked into the working capital. So whether it it's able to turn it around within say 30 days, 60 days, 90 days, how long the company takes to generate cash from the working cycle. So if it's 30 to 60 days, in 30 to 60 days, if it's able to keep on churning its working cycle, then it's a very healthy sign. Even till 90 days it's fine. Beyond 90 days it's a little alarming. But then there are these infra cap goods companies, the metal companies, for them it's a little stretched, because for them the money gets blocked into the inventories, it's get blocked into the debtors. But on the other hand, you would find the FMCG companies, the automobile companies, which are negative working capital. Now, what does negative working capital cycle basically means? It means that your creditors, so it basically means that your creditors are much higher than your inventories and debtors. So basically for the automobile companies or for FMCG companies, the debtors are almost literally nil. So whatever money is blocked a little, that is blocked into your inventories, and then they would be having the creditors for whom they are liable to pay. So for them, the creditors are much higher than the money which gets blocked into the inventory. So for them, the cash generation is very high. So that's why they don't actually need debt. Why do they need debt when they're able to generate cash from the working cycle itself? Because they get cash in advance. So while they have the leeway to make payments later for the expenses that they incur, because creditors would be nothing but whatever they are liable to pay. So while they are liable to make payments in future, they are getting cash in advance from their dealers, from their wholesalers, and other debtors. So, and a little money is just blocked in inventories, which gets taken care from the advance cash that they receive from their debtors. So that's why no debt is actually required by them, and thus, they are like very cash-rich companies, and their net cash balance sheet. Now, net cash balance sheet actually means that there's after considering all the liabilities that the company has, still it's a positive cash generating balance sheet. So that's a working capital turnover or working capital days is important. 30 to 60 days is a very healthy sign. And if it's a negative working capital that the company enjoys, and it's a really positive advantage for the industry. And then lastly, we have the valuation ratios. So valuation ratios involves price to earning and EV by EBITDA. This is the most looked after ratio, because it tells you if you have to invest into that company today, so then what is the valuation that you are ready to give for the each rupee of earning that the company generates. And P is the most sought after ratio. So that is nothing but the current market price by the earnings per share. And so basically, it will tell you whether the stock is expensive or not. But on a standalone basis, it really wouldn't mean anything. What you'll have to look at is first, compare it with the peers that are present in the industry, because every industry would have different P band. Like for example, the obviously, as I mentioned, the FMCG companies and all, because they are debt free, because they enjoy negative working capital, and plus they're the operating efficiency is much superior, the return ratios are superior, and plus they're more of a defensive kind of play, and you can say they're more of defensive kind of play, and plus their earnings are more resilient in nature, so obviously they command the superior valuations. And plus along with this, a lot of the qualitative aspect also comes into play. So that's why it differs from industry to industry valuation. So within the industry also, you'll have to compare with the peers, what is the advantage a particular company enjoys compared to the others, and that's why what kind of valuation you can actually give that company. And then you should compare it with within the company itself, you should compare it with its history, how the overall performance has been, whether it has deteriorated or whether it has improved, and why it can command a re-rating going ahead, or why a superior valuation should be given to it. So there are a couple of factors that you should consider while deciding the valuation that you are ready to pay for that stock. Another valuation is EV by EBITDA. Now, EV by EBITDA is nothing but enterprise value by EBITDA. EBITDA or operating profit. Now, enterprise value is nothing but market cap plus debt minus the cash in the books. This is nothing but, if say example, for the company has to liquidate today, or whether it is getting acquired today. So what is the value that that the market is ready to give to that company, the overall value? So what is the valuation that the company would fetch? So enterprise value is that intrinsic value basically, and that enterprise value, if we divide by operating profit, so that multiple will help us in understanding what is whether it's expensive or whether it's cheap. And this is largely used in capital intensive companies where there is huge debt in the books. Otherwise we look at price to earnings. In case of banks, price to book is largely looked at, because they are because for them asset is everything, and asset is nothing but the loans that they disburse. So they are sitting on huge assets in their balance sheet, and for them this is the most important thing. So for them we have to compare it with the net assets that their balance sheet has, and that's why we look at price to book. If the price to book is less than one, then it's obviously undervalued, and if it's more than one, it's overvalued. But then the large private banks like HDFC and all, they enjoy price to book as 3x or higher, and that is because their balance sheet is really healthy. They have a huge asset base. Their liability side is very strong, which helps them tide over the tough times. For example, like in the current scenario, obviously, since they have a strong liability side, so they would be able to manage even if their asset quality deteriorates or if the stressed assets increase, they would be able to tide over it. So obviously, given their healthy balance sheet, so they would command a higher valuation compared to the the banks which are facing a lot of asset quality issues. So these are the the ratio valuation, three main valuation ratios that we look at. But then let me tell you that only looking at valuation ratios will not help you. You will have to understand, while analyzing any company from the investment perspective, you should definitely look at its peers, how the competitors are doing, what are their strategies. So by peers, what I mean, the companies that are catering into the the similar segments. So how they are doing. So overall, what is how the industry is performing, and how the companies within the industries are performing, how the companies position within that industry, and then secondly, how the overall economic health of the country is, and given the economic health of the country, how the industry is expected to perform over next 2 to 3 years. And so, you'll have to very broadly look at the macro picture and then come down at the company level as to how these macro things would affect the company. And so everything should be looked in a tandem. The macro levels, the macro factors, micro factors, and then the financial ratios. And along with all this, one should really pay attention to the qualitative aspects, for example, how the management of the company is, because that plays a very, very important role. If the management background is not good, then they can really fudge the numbers. They can, play along because they can do a lot of window dressing. So one has to be, and for a retail investor, it becomes really difficult to, understand as to how the numbers have been fudged. So management background becomes really important, and what are the ethics that the business has, and what is the kind of experience that the business has, the management has, and how they have performed in the tough times, how they have performed in the good times. So overall, corporate governance really plays a very important role, and you should really pay attention to whether they are any kind of political affiliation do they have, or what is any kind of operator activities there in the stock or not. And apart from these, and there are certain factors like how do they treat the minority shareholders, who are the major shareholders, what is the quality of those large institutional holders, and what are the third party transactions that they're entering into, whether they are favoring their friends, relatives through the third party transactions or not. So these are certain softer aspects, one which into the retail investor should look into, which will help you and make a very sound investment. So with this, I come to an end of my presentation, and I would just say that the look study some study into the qualitative aspect as well by doing the background check by Google search or by reading blogs, annual reports, and all. And a lot of management interviews keep on coming. A lot of blogs are written by the standalone analysts or the market investors and all. So read those blogs, go through the annual reports. That's a very good exercise. So all this will help you in help you in understand the qualitative aspect, and then study the micro and the macro picture, and then dig deeper into, if still you like the company, dig deeper into the financial aspects and compare it with with its peers, and try and understand where does the company stand, and whether the valuations are attractive at this price point or not, and then you can take a call whether to invest or not. So now with this, I'll end my presentation, and we'll take on to the questions. So whatever questions you people have, you can post on the Q&A section, because that is easy to handle. Okay, so the first question is on PVR and Phoenix Mall. See, PVR is a good company, but then the problem that they're facing is that for them, the movie exhibitors were the first one to get hit. So for them, right from the start of the March, all the movie halls were closed. So revenue has completely halted, and they are the last ones to be opened. Probably they would not open in next 1 to 2 months. So it would take time for the revenue to start. And even if the halls do get if the movie the cineplexes do get opened up, the social distancing would be maintained. So obviously the full occupancy would not be there for a few months post the opening. So obviously their revenue is completely hit this year. On the other hand, they have the fixed rentals to pay. They have other fixed expenditures that has to be taken care of. So they would be incurring huge operating losses. So for next to one to for next 1.5 years, their financials will be badly hit. If you're looking from a long-term perspective, 2 year onwards, obviously it's a good buy, because people will not stop going out. I mean, it would get affected. The going out activities would get affected for a shorter period, but then post 1 year, when everything settles down, people would start going out, spending, enjoying family time, or friends time, and for them, obviously. PVR would gain out of it, and their penetration is still not that high in India compared to the global multiplexes that we look at. So obviously, on a long-term structural story basis, it's a very good structural story, and the valuations are really attractive. So one can look at entering into it, but then definitely from a more than 2 to 3 years perspective. Phoenix Small, they have very strong business model. Uh, so basically, the balance sheet is very strong, and they generate cash. It's a very cash rich balance sheet that they have, because they generate a lot of rentals from the standalone brands, or from the the other brands, the multiplexes, the food courts, and all. So. So even in the current scenario for them, the rentals are going on. Though the malls are shut, the rentals are coming in from these retailers, and obviously the revenue has got hit to an extent that the revenue sharing that they have with these retailers, so that is not coming. But then at least the fixed rentals are coming, so the revenue has not completely stalled. And whenever the malls get opens up, obviously the footfalls will start to a certain extent, though not full-fledged. But then post 1 year down the line, people would start stepping in, and the footfalls will improve. So I mean, obviously for them, uh, uh, the say the revenue improvement would they come in faster compared to the retailers and the multiplex owners. So obviously, their earnings is, you can say, it's a more steady kind of business that they have, because they generate a fixed the steady revenue over each year going ahead, and the more malls that they add, their it keeps on adding to their steady revenue generation. So one can definitely look at Phoenix Mills. Uh, I mean, if you look at the overall real estate space, then obviously this stands out like really well, because they are more into the commercial and the retail space. So obviously for them, the earnings are more resilient compared to the real estate players who are there into the residential sector. Okay, so how to know the correct financial ratios for each sector? So you would get a lot of financial sites wherein you can put these similar companies belonging to a certain industry into your the portfolio, and then so you can build a screener for each sector. Or otherwise there are various financial sites which will give you what are the financial ratios for each sector, and how the company is standing vis-a-vis the peers within that financials within that sector. So there are sites like RateStar, Screener.in, then Trendline. So and there are a couple of other sites as well. Or you can ask your broker advisor; they can also help you out. So you get these information about what are the financial ratios of this sector, as well as the peers ratios would be mentioned in that site. Where to see about the company information, its business, and the new updates about the company. Okay, so company information, as I said, annual report helps you a lot. Apart from that, on a day-to-day basis, you should definitely pay attention to the news that keeps on coming. So you should read the business newspapers. You should look at the announcements that they make on the stock exchanges. Then you should read you should listen to the news channels. So basically you have to keep yourself updated by reading the management interviews, reading the newspapers, listening to the news channels and all. And you should so all this will help you understand what are the news updates about the company, and then you can take a call. But then I would just say one thing at this point, that in a short term basis, the news does impact the company. If a company is very healthy, strong, then on a long term basis, it really, like, it depends upon the news to news, but then it really doesn't impact on a long term basis. So you should analyze the news and see whether the impact is a short term or a long term, and then you should take a call. If you're invested in a company from a short term basis, then you should analyze your news on that basis. And if you're a long term investor, then analyze it from a long term perspective, like whether how the news would be impacting the company overall, like, the shorter period or a medium or a long period. Where to check the analyst reports. So analyst reports are available on Trendline. It's available on Research Bytes. So these sites are there where you can, you can easily get the analyst reports, or you can ask your brokers, because your advisors will actually help you in giving you whatever, like, the stocks that we cover. We come out with updates on those companies from time to time. So obviously advisors must be sharing with you those reports, and if you're not getting it, then you can ask your advisors. Otherwise, you can do Google search, or you can take help of Research Bytes Trendline, and there these reports are freely available. uh, then the next question is, so we have already mentioned where you can get the industry wise ratio. um, So how to identify a forged balance sheet? See, in this, what you first you'll have to look at the management background, and secondly, you should, like, look at the third party transactions, and you should carefully study the cash flow statement. So, like, whether the company is generating operating cash flow or not, and how the free cash flow is. And so, like, overall, like, apart from the like annual report, obviously the third party transactions or the related party transactions becomes really important. But then the softer, the qualitative aspects will really come into picture. You have to dig deeper whether, like, the management, uh, like, are they involved in any kind of frauds or not in the past, and what is the kind of business ethics that they have displayed in the past, what is the corporate governance that they practice. So these things will actually, like, help you and understand whether their books might be fudged or not. And then you can look at these cash flow statements and the third party transaction, the auditors report, the corporate governance reports, the like, the chairman's message that they give. All these, if you read carefully, you will be able to understand whether, like, the numbers are fudged or not. Where to check the analyst reports? I've already answered. Then where can we get correct ratio industry wise? Answered. Uh, how to do future PAT or earnings estimate? So, see, for a retail investor, it becomes a little difficult. Just hold on for a second. Yeah. So see, basically the analysts are there to do detailed earnings estimate. But then if you want to do a quick rough estimate, then you'll have to see, like, what are the sources of revenue, and you'll have to project for, like, each revenue, like whether it's into, say, if it's into for example, like, if you look at Maruti, so it's into car sales. Now there would be, like, the three different segments: the mass segment, the premium segment, and the mid segment. So for them, like, what has been the volumes? So you'll have to project the volumes and how the pricing has been. You'll have to take a call on the pricing, whether they'll enjoy better pricing or they would see pricing pressure, and you'll have to take a call on the volume. So once you take a call on pricing and volume, then you'll get the revenue. Then you'll have to take a call, a very broad call on the expenditure. Like, you'll have to look at the historical trend, how they have been able to manage their expenditures, and whether they are doing any future capex or not. So accordingly, like, you'll understand their fixed assets, their variable, their fixed expenses, their variable expenses, and you can take a call on it. And then you'll arrive at the operating profit. Then depending upon the debt that they have and the assets that they have, you'll have to arrive at a depreciation and the interest. So you'll have to see what is the interest rate that they have been paying and take a call on the interest expense, and what is the depreciation rate that the company has been charging. Then you'll be able to take a call on the depreciation, and then you'll be able to arrive at the net profit level. So very broadly, you'll have to do this, or uh, or if you like, if you don't want to even do this, and what you can do is you can basically take how the earnings and the revenue growth has been in the past few years, and what the management is guiding into, what are the strategy that they are building, and then accordingly you can apply a certain, like, a little tapered growth rate into your the current numbers, and you can come to a certain earnings estimate. So that's how you can do your earnings, a very quick earnings estimate if you want to do, or a detailed earnings estimate as I explained earlier. So from where do we get the ROCE? As I mentioned earlier, either you can calculate it because it's nothing but your earnings before interest and tax divided by capital employed, or you can get it from the financial sites that I've mentioned, or from the research reports that are there. Okay, so HUL ROC is more than ROE. Does it mean it has negative debt? That is, it is lending money instead of taking debt. Yeah, so HUL is a debt-free company, and that's why, like, its return ratios are so superior. Uh, so basically, see what happens is, in case of uh, ROC, why it's higher than ROE? Because in ROE we consider only the net profit, whereas in case of ROCE we are considering the profit before uh, interest and tax. Okay, so obviously your profit before interest and tax is much higher compared to your profit after tax. And secondly, uh, I mean, that is like one of the major reason why in case of HUL, the ROC is higher than ROE, because for this company, your denominator, that is the equity base, is the same, because HUL doesn't have any debt. So it would be only the equity capital base, which would be there in the denominator. So your numerator is higher in case of ROCE. That's why ROC is much higher compared to ROE. Will this material be accessible afterwards? I'll check with my team whether, like, we can make this presentation available or not. So how to use these ratios in practice? So as I said, all these 10, 11 ratios, key ratios that I talked about, you'll have to look at it in tandem. You'll have to see how the growth has been for the company, how the margins are, and then you'll have, if the growth is healthy and if the margins are pretty decent, and the company has been able to maintain it or say improve it over the last 4 5 years, then study the balance sheet, how the debt equity position is, whether it's comfortable or not, how the working capital position is, and whether the returns that they're generating, it's higher of 15% or not. Because if the return ratios are not higher than 15%, then one should ignore those companies. And then secondly, look at the free cash flow generation. The company, if the company is able to generate free cash flow year after year, or at least in majority of the years, then it's a sign of a healthy business. So use these ratios together, and then look at the valuation. If the valuation is not very expensive, then you can take a call on that company. There's no predefined, so there's a question whether there's any predefined Excel sheet or software. There's no predefined Excel sheet. You'll have to take help of the you'll have to take help of the research reports that are available or of the financial sites, or you can quickly build a very basic the screener for yourself in the Excel sheet that will help you take a decision. How to obtain the data of financial statements of 10 years for the analysis purpose. Okay, so you can take the financial statements from the annual report or from the financial sites that are available. There are a lot of financial sites where these financial statements are available for last 10 years, and you can export those data into the Excel sheet, so you don't have to manually punch those numbers. So you'll be able to extract those data into the Excel and then do your number punching and the financial ratio analysis quickly. So as I mentioned, good blogs, you can look at Value Picker. It's a very good blog on the on these companies. And websites, as I said, Great Star, Screener, Trendline, Research Bytes. These are good websites which are available. Currently, since the result season is going on, so ResearchByte will tell you about the various conference calls that the companies are hosting post their results. So you can log on to those conference calls, listen to the management, understand what they're talking about the current situation, and what are the strategies that they're putting in place to tackle it, and what is the outlook that they're giving for next year or next 2 years. What is forward PE? Forward PE is nothing but we are discounting the earnings for next 1 year. So one should definitely look at the forward PE because market always look at the future rather than history. So forward PE will tell you for next 1 year what is the kind of earnings that the company is expected to deliver. So the price divided by the earnings growth over next 1 year will give you the forward PE. And if that PE is attractive, then one can look at the company. Uh, can you please suggest some good books? There are a lot of good books that are available, and I'll later on tell you which are the good books that one can look at. How to obtain the data of financial statements of a particular company for 10 years. As I mentioned, so there are a lot of financial sites, annual reports from where you can take these reports. For the presentation, I'll have to check whether you can get it or not. What is interest coverage ratio? As I explained, interest coverage ratio is basically the profit that the company is able to generate at the operating level, whether it is sufficient to service your interest or not. So the higher the ratio, it means you're in a better position to service that ratio. So even in tough times when your revenue takes a dip or your profit takes a dip, still whether you are in a if your ratio is higher, for example, in good times, if your ratio is as high as 3x, 4x, then it means that in tough times, even if your profit takes a hit, still you would be able to service your interest, because then your interest ratio would come down to, say, then from 3x it will come down to 1x or 2x. So you will be able to service your interest, because interest is something which you will have to make payment despite your poor revenues or poor profit. Okay. So Reliance, yes, the result was bad, but then from a long-term view, it's a very good investment. Uh, See, I mean, there are three segments into it. One, their petchem business. Obviously, the demand has taken hit. The prices have fallen to all-time low. But then it's a very integrated business that they have. They have got multiple crude sources, and they have got multiple feedstock sourcing. So that's a very unique advantage that this company enjoys, and that will actually help them in reviving faster compared to the other companies in the oil and gas refining space. And secondly, they have put in a strategy in place of becoming debt free by FY21. So if not by FY21, definitely by FY22 they would be able to become debt free, because they are doing a lot of strategic deals. And then they are they have announced the rights issue. So obviously these are the steps in the right direction. And secondly, they have also started generating free cash flow from Q3 FY20 onwards. So all this is pointing to us that they are, taking they're trying to improve their balance sheet strength. In fact, their capex has now reduced whatever capex they had to do into their Reliance Geo, into their Reliance Retail. So the majority of the capex has been done, and now the capex intensity will reduce going forward. So obviously, I'm sure that the company would be able to become debt free over next 2 to 3 years. And secondly, the recent deal that they've done with the Facebook, so that will not only help the Reliance Geo, it will also help the Reliance Retail. And and plus, the Reliance would emerge as a very strong play on the e-commerce platform. So overall, if we look at this company, I see it's a very good investment from a long-term perspective. What does EPS means? EPS is nothing but earnings per share. So it's the overall net profit divided by your total number of shares. That is the equity capital which is there in your balance sheet. So the total when we divide the total profit by total number of shares, we get what is the earnings that the company is able to generate per share. So for so basically this helps this is used widely for your calculation of price to earnings, because uh, you'll be able to compare price of per price per share by earnings per share. So it helps you for that analysis purpose. Can you explain the free cash flow once again? Okay, so free cash flow is nothing but cash flow that I'm generating from my day-to-day operations, that is cash flow from operations. So that cash flow, if it's positive, then I'll deduct whatever the investment is going into the capex of the company, that is into the fixed assets. So for example, say if I have to set up a plant and I have to incur a certain amount of expenditure on it, so I'll have to deduct that expenditure from my cash flow from operations. So that will give me, so whatever net cash that remains post this is the free cash flow. So if the free cash flow is positive, uh, it means that I'm able to take care of my capex plans from my day-to-day operations itself. If it's negative, it means that I'm not being able to take care of my capex plans from the day-to-day operations, and I'll have to fund it from outside. So whether be it equity market or be it debt market. So whenever a company raises funds, they have two options: either they go to debt, either they go to the banks, or they go to the capital market. So free cash flow helps in understanding, why why they have to go to the fundraising. uh, what is the net worth of the company? So net worth is nothing but the equity capital and the reserves and surplus. And reserves and surplus is largely the profits that keep on accumulating after paying off dividends and all. So whatever the profit that gets generated every year, so post deducting the dividends and taking care of certain uh, 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 taking care of certain other miscellaneous expenditures that would be there. So whatever the profit that gets the net profit that gets left over, that gets accumulated into this reserves and surplus, and that gets added to your capital, because that's nothing but the earnings that is available for the future investment. or for the for the future business requirements. So that is the your net worth of the company. How to analyze political affiliation? For this, you'll have to um, you'll have to do a lot of Google search. You'll have to uh, read a lot of blogs and all. From there you'll understand whether it's affiliated to a political party or not, or whether anybody from the political party are there into the board of directors, or uh, associated with the company in any form. So that's how you'll, like a lot of construction companies, you would find they would be affiliated with political parties in order to get favors, in order to get the orders in the in order to bag new orders. So you'll have to read a lot of blogs and do a lot of Google search, and look at their board of directors, and that's how you'll understand whether they are affiliated to the political party or not. What are the ratios? What are the ratios we should look for? Tire, logistics, media company. See, the more or less the ratios are same. It just varies very slightly. For example, in case of media companies, it would be like you'll have to look at. I mean, the common ratios that I talked about, that obviously you'll be looking at. But then for media companies, you'll have to also look at the per screen, what is the revenue that they're generating, or what is the profit that they're generating. Then in case of, say for example, in case of logistic companies, you'll have to, if you want to really dig deeper, you'll have to see per, if it's into supply chain kind of thing, warehousing kind of space, then the per area of the space that is used by them, what is the revenue or the profit that they're generating. So, these are the specific industry to industry ratios you can look at if you want to really dig deep into it. Otherwise, the common ratios that I talked about, that is fine for a retail investor. Which sector to look considering the current scenario? See, in the current scenario, from a medium term perspective, we would suggest FMCG companies, which are into the staple kind of business. Then the technology companies, IT. Then you can look at telecom. You can look at the companies which are crude derivatives, like Asian Paints, Pidilite. In case of telecom, obviously like Reliance Jio is there, Bharti Airtel is there, FMCG, HUL, Nestle, Dabur, those kind of companies. Then in case of IT, as I said, IT, it would be TCS, Infosys, HCL Tech. In mid-cap space, probably LTI. So these are the companies that you can look at. Apart from this, healthcare sector is there, wherein obviously it's gaining from the current situation. So you can, in the large space, you can look at Divis, Dr. Reddy, or you can, in the smaller space, you can look at IPCA, Alchem, Cadila. So these are some of the sectors that you can look at, and you can also look at some of the select, the large private banks and the NBFCs. For example, HDFC Bank, ICICI Bank, or Kotak Bank. And in case of NBFC, HDFC Limited or Bajaj Finance. So I would, I mean, because these are, though their businesses would be hit, but then since they are very strong players, so they would definitely gain out of the smaller players because of the current situation, and their market share is likely to improve going ahead. Uh, yes, one should definitely look at the rating agency reports as well, because that also helps you, get some perspective as to how the rating agencies look at these companies. Okay, so by political affiliation, I mean the companies who are not politically affiliated, they are better off, because, if, say for example, some company who are largely affiliated to say Congress party, and with now Congress not there as a ruling party, so it would definitely affect them. So that's why the companies should not be politically affiliated. That you should definitely take care of. And if they are politically affiliated, then it depends which the company is strong in which state, and then in that state which ruling party is there. So as you said, DMart and other startup companies, they don't have political affiliation, so definitely it's really good for them, and it's a healthy sign. But when a company has to take favors from the political parties, and it's not a good sign. As per your analysis, which are the top 5 companies which are the safest and bound for good returns over a specific period? Okay. So see, there are lot many companies. I can give you a list of 20-30 companies. Okay, so I can give you a list of 20-30 companies which are there. So that wouldn't be a problem. Just 1 second. Yeah. Okay, so you'll have to see what is your investment horizon, and what is the kind of companies you are comfortable with. I mean, what I can suggest is look at a diversified portfolio, um, wherein you have some companies from consumer, IT, then healthcare, banks, because so, and then you can take on so see, I can just give you what are our topics. For example, our topics would be HUL, then Davis, Nestle, Reliance, HDFC Bank, then your Dr. Reddy, then we have Bharti Airtel, then we have ICICI Bank, Infosys, HDFC Limited, Ultratech. These are in the large cap space. In the mid cap space, we would suggest JK Cement, Tata Consumer, then IPCA, Alchem, then we have ICICI Lombard, Dr. Lal. So there are a lot many companies which are there. Just see the parameters that I've given, and select the industry which you understand and which you'll be able to track going ahead. So select companies from those industries which you really understand. The companies that you can understand and you can track, you should invest on in those companies. JK Cement, we are very positive on JK Cement, though the company has run up. But then, see, JK Cement is a north-based player, and we believe that though I mean for the cement sector, the volume has got hit, but then the north-based players would be able to recover faster compared to the other players, and the reason behind it is that there the capex expansion that is happening is very limited. So these companies would be able to improve their utilization. Though now for next 1 to 2 years there would be certain strain on their capacity utilization, but then the recovery would be faster in case of north-based players. And plus they would have because of the better utilization, they would have better pricing, and we have already seen the higher pricing in case of north-based players. So JK Cement among the mid-cap cement players is definitely our top pick. I've already explained free cash flow. Uh, Okay, so we don't have our coverage on Sterlite, Indostar, Bajaj Consumer, Moltech, so I won't be able to give my view on them. Uh, so there's a question on how to analyze the qualitative aspect. As I've mentioned, you'll have to you'll have to read the annual report, and in annual report you'll have there are certain sections like the management discussion, the chairman's message, so that you can read and understand. Then you can read good blogs, the management interviews, so that will if you read them carefully, you will be able to check on the management quality. Then you can also understand from the the strategies that the company takes from time to time. So the and how those strategies have panned out in the past. So that will also tell you whether the company is able to deliver or not able to deliver. Plus, you can look at what is the kind of salary that they draw each year. What is the kind of the lifestyles that the promoters maintain. So these are the softer aspects which obviously you can I mean, you'll have to understand over a period of time. uh, so the more you read, and the more you'll be able to understand on these qualitative aspects. And then you'll have to also try and see find out whether they have been they do a lot of insider trading or not. They have been involved in any kind of fraud or not. So these are certain aspects which can help you out. uh, See, I'll have to check whether the recording and the ppts are available or not. Maruti, see, from a 2 to 3 year perspective, definitely you can look at it because it has fallen a lot. Valuations are very, very attractive. So obviously one can look at it. I mean, it enjoys a market share in the in the PV segment. So it's a leader in its space, and I mean, it has been able to maintain its market share over the years. So obviously, one should definitely stick to the leader if one has to look at the auto space. And plus, Maruti has a good balance sheet, healthy return ratios. So definitely, from a long-term perspective, given its valuations, one can definitely enter in a staggered fashion. Bank of Baroda, I would say you should avoid it in the current scenario uh, because though it would benefit out of the consolidation that has recently happened, but then that consolidation would take time to play out. And currently, with the consolidation happening, there has been a certain stress on the balance sheet, and plus, in the current scenario, the stress would further increase for them. Because the loan growth has got impacted, and there would be more of stressed assets that would get increased. So obviously, the asset quality will deteriorate. So in coming months, there would be a lot of stress on the stock price. So one should avoid it for the medium-term perspective. Okay, so let me end the meeting now, and I think I've answered many of the questions. If you have further questions, you can get back to your advisors, and we can help you out through them. So that's it for the day. Thank you, and stay home, stay safe. Now you can all log off. Thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.